Zscaler. You've almost certainly heard the name. It's one of the heavy hitters in cloud security, but its stock has been on an absolutely wild ride. So, the big question on every investor's mind right now is, well, it's pretty simple. Is this a revolutionary company that's just getting started, or is it a dangerously overvalued stock it's just waiting to pop? All right, let's open the case file on Zscaler and find out.
And I mean, just look at this. The stock chart looks less like a steady climb and more like, well, a roller coaster. We've seen these incredible soaring peaks followed by stomach-churning drops. Behind all these swings, there's a really fascinating story about new technology, explosive growth, and a super high-stakes debate about what this company is actually worth. Our mission today is to cut through all that noise and figure out what is really going on here.
So to even begin to understand the investment, we first have to understand the mission, right? What is the fundamental problem that Zscaler solves? And why are huge, massive companies paying them billions and billions of dollars for it? It all kicks off with a concept that is totally changing the game in cybersecurity. And that concept is zero trust. It sounds kind of intense, doesn't it? But the idea is actually super simple. Forget the old days of trusting people just because they're physically inside the office network. In today's world, with cloud apps and everyone working from everywhere, the network is the internet. So, zero trust means exactly what it says. Trust no one. Verify everything. Every single time a person or a device tries to get to an application, they have to prove who they are. No exceptions. You know, you can think of the old security model like a castle and moat. You build this big, thick wall, that's your firewall, and a drawbridge, that's your VPN, and you just assume anyone who gets inside is safe. But what happens if the bad guys are already inside? Or if your own employees are working from a coffee shop halfway around the world? The whole model just falls apart. Zscaler's approach? It's completely different. It's more like a giant superintelligent switchboard that lives in the cloud. It connects the right user directly to the right application and absolutely nothing else. It's way faster, way more secure, and it's built for the way we work now. Okay, so the mission is clear, and the idea is powerful, but does the evidence, the hard numbers, actually back it up? Let's put on our detective hats and decode the numbers from their latest Q1 earnings report, because this is where the story gets really interesting. First thing that jumps out, top-line growth. Revenue just shot up an impressive 26% year over year. Now, in a tough economic climate like this one, that kind of growth is a huge signal. It tells you that the demand for what they're selling isn't just strong, it might actually be accelerating. Next, let's look at the stability of the business. They now have over $3.2 billion in annual recurring revenue. And the key word there is recurring. This isn't just one-time sales. No, this is predictable, subscription-based money coming in from thousands of customers who are deeply embedded in the Zscaler ecosystem. It's sticky. But this next number, this might be the most impressive one of all. 52%. That's their free cash flow margin. Let that sink in. For every single dollar that comes in as revenue, 52 cents becomes pure cash. That is an absolutely staggering metric. It shows the business isn't just growing, it is a literal cash-generating machine. So the growth is fantastic and they're printing cash. But this leads us to probably the most crucial question every tech investor has to ask. Are they actually profitable in the way you and I think about profit? The answer? Well, it's a bit complicated. Okay, so on the left you've got GAAP, which is the official by-the-book accounting. By that measure, they lost about 11.6 million bucks. But then on the right you have non-GAAP, which is how the management likes to look at the business. And by that measure, they made almost 160 million. So what's the big difference? Well, non-GAAP pulls out non-cash expenses, and the biggest one is stock-based compensation for employees, basically paying people with company shares. The bears will tell you GAAP is the only truth that matters. The bulls say non-GAAP shows you the real cash power of the company. You have to understand this difference. It's critical.
All right, let's pivot and talk about the biggest topic in technology today, AI. We can't possibly analyze Zscaler without asking this question. Is this explosion of generative AI a massive threat that could make them obsolete, or could it be their single greatest opportunity?
Well, Zscaler CEO Jay Chaudhry is leaving absolutely no doubt about their strategy. He's basically arguing that as companies race to use AI, they're creating massive new security vulnerabilities. And the only way, he says, to safely connect your employees and your AI models to all your sensitive data is through a zero-trust framework. They're positioning themselves not just as a part of the AI revolution, but as the essential gatekeeper for it.
And look, it's not just talk. They are backing this up with serious action. They've gone out and made key acquisitions like SPLX and Red Canary to bake cutting-edge AI security right into their platform. They've also been tightening their partnership with giants like AWS, earning a special competency in AI security. They're clearly placing a huge bet that AI is going to be a massive tailwind for them, not a headwind.
So, we've seen the mission, and we've examined the evidence. Now we get to the heart of the conflict, the central tension in the entire Zscaler story. This is the battle between the bulls and the bears, and it all comes down to one thing. It's sky-high valuation. Okay, I want you to take a deep breath and look at this chart. This is a common way to measure a company's value against its earnings. As you can see, a giant like Microsoft trades around 16. A key competitor, Palo Alto Networks, is around 55. And Zscaler, it's trading at a multiple of nearly 8,800. No, that is not a typo. The market is not pricing this company on what it earns today. It's pricing it based on what it hopes it's going to earn many, many years from now. An extreme valuation like that creates two very different and very passionate arguments. So let's break them down side by side. The bull case versus the bear case. The bulls, they argue that you have to pay a premium for the absolute best in the business. They see a dominant leader in a huge and growing market. They'll point right back to that consistent 25+% growth and the incredible free cash flow as proof that this is just a superior business model. And they believe Zscaler is perfectly positioned to ride that coming wave of AI security spending. The bears, on the other hand, they look at that same valuation and they just see a giant bubble. They argue that no company, no matter how good, is worth that kind of multiple. They'll point to the intense competition from giants like Microsoft and Palo Alto. But their biggest fear is something called multiple contraction. That's when, if growth slows down even a little bit, that huge multiple could shrink dramatically, causing the stock price to just plummet, even if the business itself is still doing great. So, we have the bull case and we have the bear case. A fantastic business versus a truly breathtaking price. How in the world do we synthesize all this evidence to come to some kind of verdict? Well, let's see what the pros are thinking. The analysts on Wall Street have basically mapped out a couple of potential futures here. In the optimistic scenario, Zscaler just keeps executing perfectly, they become the clear leader in AI security, and they eventually grow into their premium price. That could put the stock somewhere around $350. But in the pessimistic scenario, if growth slows, the stock could easily fall back to the $150 to $180 range, a huge potential swing. So, if you boil it all down, the consensus on Wall Street is what you'd call a cautious buy. The message is crystal clear. Everybody agrees this is a high-quality, market-leading company. But that price tag makes them very nervous. The recommendation is basically, we absolutely love the company, but please be very, very careful with the stock's valuation. And that really brings us to the final question you have to ask yourself, doesn't it? Zscaler is a classic investor's dilemma. A truly fantastic, cash-gushing business that is trading at a potentially terrifying price. The question isn't whether the company is good. The evidence overwhelmingly shows that it is. The real question is whether the stock price has gotten so far ahead of itself that it's simply too good to be true. And of course, just as a final note, please remember that this analysis is purely for educational and informational purposes. It is not, in any way, financial advice. You should always consult with a qualified financial professional before making any kind of investment decision.